Good afternoon, everybody. My name is Bobby Rains. This is our Investors Observer members only workshop. Welcome. All right, so this is our agenda for today. We're going to look at some charts. Charts are actually kind of interesting this time around. We'll talk about what sectors and industries are hot right now, look at what else is happening in markets and the economy, talk about some banks, specifically Silicon Valley Bank, maybe how worried you should be about your bank. And then the rest is member-driven content, questions, site demonstrations, whatever it is that you're interested in. You can ask questions at any point by just putting them in the GoToWebinar question box. I've got two monitors here, so I usually keep one eye on that. So if you have a question about what I'm talking about, I usually try to get to those in the moment. Other questions I'll get to at the end, but you can put them in the box at any point. All right, with that said, let's get to the charts. All right, so the S&P 500, our last talk was about here. We are down from there, obviously. We had the two big down days relating to mostly people being worried about banks, and then it's been kind of choppy, but it has generally been kind of choppy really since our last workshop. But yeah, there was some volatility in there. The S&P is maybe the least interesting one of these. The NASDAQ, if you look, we were about here at our last workshop. We're at about the same level, which is doing much better than we were on the S&P 500. This is largely due to the dearth of banks on the NASDAQ. There's aren't very many banks there. Banks and some other financial services things are what's down big. So it makes sense that the NASDAQ would be doing better, relatively speaking, than the S&P 500. The Russell has really taken it hard. There's two things going on here. One is there's a lot of banks, especially those smaller community banks in the Russell 2000. Also, a lot of small cap stocks are sort of in the pool of stocks that banked at excuse me, banked at Silicon Valley or otherwise. People were worried about some sort of contagion effect. So it's down pretty sharply since we last talked. Mostly, it's the 2 days the S&P 500 was down, but it was just down a lot more and hasn't been able to make any of it back. All right, so the S&P 500 versus equal weight. This is a thing where we've been tracking the spread for some time now, as the big tech stocks at the top of the S&P 500 have underperformed the sort of, the S&P 495. All the stocks that aren't Apple, Google, Microsoft, Tesla, probably like Meta or Netflix, something like that. But here recently, we have gotten back to pretty much parity in terms of performance over the last 12 months. This is due to the fact that those big tech stocks at the top of the index are not in the financial sector, and nobody's really worried about where they're banking. So they've done relatively well, maybe even benefited a little bit in terms of providing a little bit of a place for flight to quality, while the banks and some of the other stuff in the S&P 500 has struggled a little bit more. But it is interesting to see that close. That's not really what I was expecting to close it, but I don't think anybody was really expecting we would be talking about a bank run this time last week. So, and yeah, growth versus value, a similar thing. The value stocks have really slid along with the value stocks have really slid along with the bank stocks, and the growth names down a little, but not as much. Certainly, the gap here is getting tighter. So it's a little bit of a reversal of the trend we've been seeing for the last year in terms of what's up and what's down, but a lot of it is really due to this dislocation in banks that we will talk about a little bit more in a little bit later. But yeah, it's not that anything is really outperforming or performing super well. It's just that the banks in particular are performing very badly. All right. So sectors that are hot right now, and some industries. Energy remains at the top. Thermal coal still looks really good. Oil and gas midstream and then refining and marketing are now those top sectors. So this is not the drilling. Refining and marketing is exactly what it sounds like. It's, you know, oil refiners, and then marketing is selling it. So a lot of the, you know, branded gas stations, you know, some of them are branded the same as a refiner, like a Valero or something like that. It's companies in sort of those industries, right? It's the more consumer facing industries, and then midstream is a lot of transportation and storage, so pipelines, things like that. This, I think, reflects the price, the fact that energy prices, at least the crude oil prices, down a little bit more recently. But midstream and refining and marketing are able to hold prices for what they're selling relatively steady. So I mean, think about any business. If the input costs go down and the retail price stays the same, you're doing all right. So that's kind of what's going on there. Industrials is up next. Industrials have been slowly sort of climbing this list. Airports and air services, infrastructure operations, rental and leasing services. Two things stand out about this group. One, everything I just said about oil prices being lower. You know, if they can get cheaper fuels, that's going to help. All of those things. Also, these are generally sort of good economy sectors, right? People are moving stuff around. People are moving themselves around. People are renting equipment or spaces or, you know, whatever it is that they're renting, you know, from those rental and leasing services. That's all sort of, you know, relatively positive outlook on the economy kind of stuff. As is energy, to be fair. Consumer defensive is usually a little bit more cautionary. Defensive is right there in the name of the sector. Brewers, confectioners, discount stores, that's a relatively safe set of names. So it is, again, right, a little bit of the story we've been talking about for a while, but they have moved up on the list, and for the first time, probably not for the first time since we've been doing this, but certainly for the first time in a while, we have consumer defensive and consumer cyclical on here. I think, right, it's just a lot of consumer exposure, because, as we've talked about for a while, the consumer remains relatively strong in this economy, right? Like there are places where we're seeing layoffs, mostly in tech. There are some things that are weak in terms of advertising and some things like that, but the consumer remains pretty strong. So selling stuff to consumers is good business. That's part of what's going on here is, you know, we're just, you know, making money by moving stuff to bring it to consumers. Residential construction, luxury goods, resorts and casinos. Residential construction is kind of interesting to see at the top of this list. There's been a lot of people talking about problems in the housing market. Obviously, higher interest rates don't really help, but the home builders have done, for them, a pretty good job of not overbuilding. They're essentially, you know, every house they build is pretty much sold before it's finished. So they don't have a lot of inventory when, you know, buying slows down. They don't have a lot of inventory. They don't have to reprice a lot of inventory, anything like that. So there may be some slowing there, but their margins are doing quite well. And I don't really think new home construction has slowed that much. I think it's been a lot of existing home sales has been where some of the slowing is. And then, yeah, utilities moves way down the list here, I think, due to largely the strength in the other sectors. But yeah, utilities, diversified water, electric, those are, again, typically a defensive play. So we're still looking at this sort of mixed picture here in terms of the economy and what this short-term technical score is saying about these things. But it's interesting to see these consumer plays come in here. All right, let's show you where I found this stuff. You can find this at any time by going to stocks and then sector and industry. And you can sort these by any of our 7 proprietary scores. I use the short-term technical score for this because I like to look at sort of how things have been doing over the last month or so, which is what that measures. So that's That's where to find that. And I think it's kind of an interesting way to look at the market and sort of how investors and traders might be thinking about the economy. All right, so what else is going on? Economic data remains generally pretty good. We've seen some softening in a few areas here and there, but nothing that really looks, nothing that's, no flashing recession signs really. The labor market remains, I'm going to say, sort of almost stubbornly strong. We keep adding more jobs than people are expecting. The unemployment rate keeps falling. It seems to be slowing a little bit. And then there is, the wage growth seems to be also slowing a little bit, which is, I think, a positive if you're worried about inflation. It's not necessarily a positive if you're trying to get a new job, but it's, a positive on a broad scale if you're worried about inflation. Interestingly, this week we saw CPI. I guess the monthly change is going down, but prices are still going up. So CPI is slowing, whereas the producer price index has actually been down 2 of the last 3 months. Which, interestingly, if you think back to those consumer-facing sectors we were just talking about, lower producer prices and still high consumer prices means better profit margins for those companies that are buying things and then repackaging them or processing them in some way and selling them to consumers. So that spread in terms of performance between the PPI and the CPI probably flows through to earnings for some companies, here and there. So that's kind of an interesting thing to look at. I think the Fed's task has gotten a lot more complicated this week. There was a lot of talk last week about the potential for an increase of 50 basis points at the meeting next week. I think that probably looks more like 25. We'll see. One of the things that Powell has said for a long time and is sort of, I guess, it's in the central bank handbook, I suppose, is the phrase long and variable lag in terms of how monetary policy affects the economy. I think some of that is sort of starting to show up now in terms of the problem with a couple of banks and some of the other things. I think it probably does mean a slower pace of hikes for a while. Powell said like Tuesday of last week, 50 basis points is not out of the question. But I'd be very surprised if that happened next week, and we'll see where we go from there. But I think they may go sort of smaller hikes for longer as opposed to making some bigger hikes, but we'll see. That may mean that the hiking cycle just sort of lasts longer. It may also mean that the rate is ultimately lower than it otherwise would have been. We'll see what happens when the dot plot, which is what they call I forget what the name is, the official name. It's the projections from the people at the Fed in any case, in terms of where they think interest rates will be and where they think unemployment and things like that will be. So that will be a pretty interesting thing, as will the press conference and Powell's comments, especially with all the bank stuff that's gone on this week. The housing market is slowing. That's typically a thing that happens when interest rates go up. The home builders, like I just said, are still doing pretty good. Prices for existing homes have stalled a bit with higher interest rates. That makes sense. If you think about housing affordability, a lot of what comes in terms of housing affordability is what is the monthly payment. And so if interest rates go up, either that monthly payment has to go up or the housing price has to go down. And people may not want to, lower the price. That people may have a price that they want for their house, and they may not be willing to lower the price. So it turns out, in a lot of cases, you can just stay in place, right? Maybe you were looking to move across town, and now you're not. Right? Nobody really nobody really leaves the housing market voluntarily, right? Like, sometimes people say I'm getting out of the stock market or whatever else, right? You sell all your stocks and go to cash or give it to an investment advisor who puts it in mutual funds or whatever. That's the thing that happens. People very rarely leave the housing market by choice, right? Everybody wants to buy a house. So if you're going to sell a house that's a pre-existing house, you are probably going to look at buying another one. And so when interest rates go up and you have to do that monthly payment math, now all of a sudden you're looking at maybe less for your existing house and paying more for a new house. Maybe that move is less attractive. Debt ceiling. Not really close enough to be a concern yet. It is something that I'm kind of keeping an eye on. I expect we'll be hearing out a lot about it a lot more as we get closer to June, which is, I think, about when we're currently scheduled for the government to run out of money. The first thing to watch is the short-term Treasury note market. There's been some volatility there this week. This volatility is not that. This is largely related to, basically the funding markets for banks and them trying to match their assets with their liabilities much more than anything relating to the debt ceiling. And really, when I talk about the debt ceiling, I mean things in the 3 month, 1 month, 3 month, 6 month kind of, the note market, not stuff like the 2 year or longer dated maturities there. All right, so let's talk about banks. First, just a quick sort of primer on how banks work, right? So this phrase borrow short to lend long that's what a bank does, right? So they borrow in a number of short-term markets, including taking deposits, to lend long, right? You think about a mortgage for 30 years, or they buy bonds or various other things that tend to be a longer borrowing than, a deposit. So that's the basic business of banking, right? That borrowing and lending. Short-term rates tend to be lower than long-term rates, so that's where some profitability is, right? I'm borrowing money at 1%, I'm loaning it out at 3%. I'm making a spread there. Rates also tend to be higher with risk. So deposit rates tend to be lower than rates for riskier things like a mortgage or a business loan or an auto loan or something like that. A bank deposit is sort of by design one of the lowest risk things you can have. And so that makes sense. So there's also a little bit of spread in that. Now, in modern banking, especially since the financial crisis, there's a lot of services and fee revenue that has come on, but that phrase borrow short to lend long is really the core business of banking. Now, certainly you're like Goldman Sachs's and even you're like Citigroup's and JP Morgan's have a lot of other stuff going on in terms of like investment banking and asset management and stuff like that. But especially as you go to the smaller, more regional banks, that borrow short to lend long is really the sort of core of the business. And so what that means, if you think about it, is rather than having an operating business, the bank's business is the balance sheet. So if you think about a company that makes widgets, they have they have to buy raw materials, they have to pay workers, they have to maintain a factory, and then they sell widgets and they invoice for that and they get paid. So there's some amount of balance sheet there because you don't necessarily get paid for the widgets you just sold on the day you have to pay your employees or on the day you have to pay machinery repairs or pay for raw materials, right? So there's some amount of balance sheet there in terms of keeping some cash on hand in excess of what you probably need in any given day. And that is how a business generally sort of manages its balance sheet. Assets also tend to be a lot of fixed things like machinery and things like that, where liabilities are, maybe loans you have taken or invoices you have outstanding. With a bank, the business really is the balance sheet, right? So you have on the liability side, you have deposits, some bonds, some other borrowings, things like that. On the asset side, you're also making loans, you may be buying bonds, maybe lending through some other sorts of vehicles, things like credit cards, stuff like that. So what you're trying to do is get a return on your assets that is greater than the cost of your liabilities, right? So you think about, okay, I have this pool of loans that I've made and a pool of loans that I have taken out, and I need to make more from the loans that I have made than the cost of the money I'm borrowing plus my operating costs. Okay. So that's essentially how that works, right? It's managing the balance sheet to get that to work out. And then you also have to do all the time things, right? Like, oh, somebody wants their money today, I have to have cash today. You have to work that out as well. Now, the thing is, most of those assets and liabilities are essentially contracts, right? Somebody is lending money to be repaid with interest on some schedule. Mortgages are kind of a weird example of, and some other consumer loans is an example of something that's what we call pre-callable. But most bonds and other things are paid on some schedule with interest. And in a lot of cases, you have to get the permission of the lender to pay off the loan early. Because if you pay off the loan early, you're essentially taking away some amount of interest payments from the lender, and they had probably planned on getting those. So it's a contract, it's on a schedule, things like that. So it's pretty easy to predict your maturities and your cash flows in that regard for most things. The major exception to that is deposits, specifically what are called demand deposits, which is think checking account, savings account, things like that, right? Not CDs or other things which are known in the banking industry as time deposits. So demand deposits are callable at any time, right? You can just walk into the bank and say, hey, give me my money, and they, have to give it to you. So that obviously creates some risk because you have a lot of liabilities that are these contracts that have defined times in them, and then you have a big pool of assets that you have a lot of assets that are timed, et cetera, and this big pool of liabilities that can essentially be called at any time, right? In terms of household budgeting, imagine if the cable company could just call you at any day of the month and say, we need our money today, right? Or if all of your bills were like that, where somebody could just call you at any point in the month and say, hey, today's the day, we need this now. That creates some problems potentially. It's hard to match the sort of duration of assets and liabilities when you don't know liabilities will be called. And so when you start having those trouble, that's when you get into a bank run. So I didn't put on the slides here, but the terms liquidity and solvency get thrown around a lot. So solvency is your assets should be greater than your liabilities, right? If you sold everything and tried to pay off all your debts, you should have, best case scenario, break even, ideally more assets than liabilities. You come out with some money ahead in that case. Liquidity is about cash today, right? So what happens to banks is in a bank run, they all start with a liquidity crunch, right? So it's more people are asking for cash today than we have cash on hand. We have assets, the value of those assets may be greater than our liabilities, but if we have to sell a bunch of our assets for whatever we can get for them, potentially we're looking at a solvency problem in that case. And so one purpose of deposit insurance is to prevent bank runs, right? Like, guess what? I don't have $250,000 sitting in a bank account. I'm profoundly unworried about the safety of my bank deposits. It's just not a thing I worry about. And so I didn't even consider going and moving money around. I don't have any money at Silicon Valley Bank. I'm on the East Coast, whatever. Right? That is why deposit insurance exists, is to prevent bank runs. All right, so what happened at Silicon Valley? Silicon Valley is a weird bank. It's not doing a lot of consumer lending. It's serving, as the name implies, Silicon Valley. But also a lot of startups and VC-funded companies elsewhere in the US and to some degree around the world. So what that means is they had a lot less diversification in terms of liabilities than most banks have, right? So, I mean, if you think about a community bank, there's probably people who have all kinds of different jobs. There's a bunch of different businesses that are all doing their banking there. So you may have an auto dealership and a home builder and a bunch of individuals, and they all have different needs and things like that, and the bank is able to handle that. If you have a lot of concentration in your liabilities, the chances of all that money going out the door in a relatively short period of time gets a lot higher. Particularly if you're looking at VC-funded tech startups that aren't profitable, that's a group of businesses that are very sensitive to rising interest rates. Silicon Valley also got a lot of new deposits during the VC boom of the last several years. So a ton of money flowed in. We'll look at a chart of Silicon Valley stock compared to some other banks in a couple of minutes. They got a lot of deposits. I think that assets under the things sort of tripled almost. It also ran a what was called a high touch business, right? So relationship banking, working for businesses, and paying those people and those bankers is a lot more expensive than just having some tellers in a lobby and an ATM network. So if you think about, right, return on assets needs to be greater than the cost of liabilities plus operating expenses. Those operating expenses are relatively high for Silicon Valley compared to some other banks. So that combination caused the bank to sort of reach for yield a little bit. And they didn't do this to their credit, I think, by buying risky assets. Okay, they bought some longer dated instruments that have higher interest rates because, like I said earlier, longer yield, longer dated things tend to have higher yields. They are more sensitive to changes in interest rates, though. Right, treasuries and agency MBS, they're government backed. They're pretty much always money good if you hold them to maturity. The problem is if you can't hold them to maturity. So what happened is that lack of diversification on the liability side, Silicon Valley and the VCs, it's a relatively small group of people, right? Like it may be a lot of companies, but you think about, like, say, Peter Thiel's Founders Fund has invested in a bunch of companies. And so when he says, hey, go pull all your money out of Silicon Valley Bank, that's a bunch of people pulling out. The other thing is it's a very close sort of group. And they all, it's a real sort of herd mentality situation, right? These are all people that went big on crypto and Web3 a couple years ago. They're all trying to find the hot AI startup now. And so if you think about everybody just trying to pile money into things, also nobody wanted to be the last person with their money sitting at Silicon Valley Bank. So boom, all the money tries to go out the door in one day. I think something like $42 billion got withdrawn on Friday, which is an incredible amount of money. So the assets were worth less than the company paid. This is really only on a mark-to-market basis. There's no, right, we're talking about treasuries. There's no real indication those assets are impaired or they would be worth less if held to maturity. The problem is when $42 billion walks out the door in a single day, you no longer really have the opportunity to hold those assets to maturity. So you have to sell them and take the loss. The company also had no chief risk officer for most of 2022. It was suggested to management to shorten the duration of their assets in 2020. Apparently, even as the Fed was saying rates would rise, they still didn't really make a lot of effort to do that until it was too late. That, I think, is the management mistake here, is not recognizing that your liabilities are sensitive to interest rates as well as your assets. And then when they tried to raise capital, it was too late, right? So raising capital is essentially selling shares. It could also be selling bonds. In this case, selling shares. So if you think about a bank, if the first day a bank opens, if you come in and say, I'd like to borrow $100, they won't say, well, we don't have $100 in deposit yet, deposits yet, so we can't lend that to you. The first loan is made out of shareholder equity, right? So the bank has some money that's owned by shareholders. Excess profits go to shareholders. That is also where the first loss comes from. So they tried to sell more stock and couldn't get it done. So that didn't work. The VCs started to really pull their money out in a hurry. And then at that point, the FDIC steps in to protect depositors. And importantly, it also takes over whatever assets remain. The FDIC can provide some immediate liquidity and keep the assets to maturity because its funding looks different than what happens at Silicon Valley. All right, so the aftermath, right? Like, how do you stop a bank run? Because if this bank goes down now, some people might start to worry about their bank. So the FDIC said all deposits to Silicon Valley would be covered. Now, there's been, I think, maybe one or two banks in the last 20 years where it failed and 100 depositors took any kind of haircut, including the depositors above the insurance limit. That's because when you liquidate a bank, the depositors get paid back first, right? So the shareholders go to zero, bondholders may take a haircut, deposits get paid back first. So you'd have to see a pretty significant loss on those assets for the deposits not to be made whole. But a bunch of people, right, in the VC community, I don't know how many of you are on Twitter, were very upset and being very loud on Twitter that they didn't have immediate access to their funds, despite being people that should know what the FDIC insurance limit is, and being the people that sort of, took all their money out of the bank to begin with. They were also leading the crypto charge and proclaiming the government was sort of the source of all the banking and finance problems in the world a couple of years ago. So I'm not particularly sympathetic there, but I do think it's good that depositors get their money, right? Like, that is generally good. Partially because covering all the deposits should help limit deposit flight from other banks that have a lot of uninsured deposits. Now, a crypto-heavy bank went down earlier in the week, and then Signature Bank in New York, which also did a lot of crypto banking, was taken over by regulators over the weekend. But that's it. No other banks have failed. And it's not impossible that some will. I don't have a list in front of me of the likely ones, but I'm not particularly worried about it. Right, and the Fed set up a new facility to kind of help other banks that might be in a similar situation. And what that does is it lets you borrow against assets at the face value as opposed to having to borrow against them mark to market. Again, the Fed has different funding than a bank. They can afford to hold assets to maturity. The loans they're making are only good for 1 year. The program is only lasting for 1 year. And you can't, I think sort of most importantly, you can't go out and buy a bunch of bonds below par and then take loans against them, right? So they had to be on your balance sheet before last Friday for this to work. So it's a temporary program, but it should help keep things stable. Also important, I think, to this is all the executives at Silicon Valley lost their jobs. The shares are assumed to be worth zero. This is different than the bank bailouts in 2028, right? Like, a lot of executives kept their jobs or got golden parachutes. Stockholders weren't. We'll look at another chart in a minute. Stockholders weren't entirely wiped out. So in terms of a bailout, you can call making depositors whole a bailout if you want. But the people who are running a bank that did bad did not come out of this really ahead. All right, so should you check on your bank? Probably not. If you have less than $250,000 per institution, you're automatically covered by the FDIC. There is also now an sort of implicit backstop of all deposits. So a question I have for, VCs aren't taking my calls, but a question that I would have to a lot of them, especially the ones that had, in some cases, hundreds of millions of dollars at this bank, and they didn't immediately need it for working capital. Why was it an account with right? The lowest possible return, I'm assuming the interest paid was basically zero. If it were me, I would probably look at the CEO or CFO of some of those companies and be like, hey, why don't you try to take some of this money that we don't need right away and put it in a money market fund, 3-month treasuries, something that has some return on it anyway. Also, yeah, most banks don't have these problems. The giant banks, right, the JP Morgan, Citi, Bank of America, that group, they have different rules, which used to apply to medium-sized banks and will hopefully come back. And also, most smaller banks have a more diversified set of depositors and haven't had such a giant ramp up in assets. So not super worried about that. And from a systemic and regulatory perspective, nobody actually wants depositors to have to do due diligence, right? Like what this would lead to is more deposits at the too big to fail institutions, which makes them even bigger. And bank deposits are generally supposed to be a risk-free asset, right? Like if you're a banking regulator, if you introduce any element of risk to deposits, you change the incentives for both the bank's customers and for the bankers, right? So what you want is $1 in any bank should have the same value as $1 outside a bank or at another bank, right? Everybody should assume that $1 is $1 is $1 as far as bank deposits go. And so, right, like I think this is kind of the right way for this to work out here. Yeah, so. All right, what about bank stocks? Some of these dynamics will apply to all banks in terms of falling bond prices may hit earnings, right? If you think about how much is a bank worth, it's worth the value of its assets less the value of its liabilities. So if the value of the assets goes down, the bank is worth less. That shows up in earnings eventually. Another thing is deposit rates have lagged the increase in interest rates by kind of a lot. It's likely that that will change because banks would like to not have to take those mark-to-market losses on their assets. The way they do that is to keep liabilities in-house, and the way to do that is pay some yield. So I would sort of expect maybe lower earnings than the last couple quarters from more traditional regional banks. Regulatory picture is really unclear. Changes are likely to also, push down earnings. So it's not necessarily saying to sell bank stocks. A lot of the banks are fine, and after this week have pretty high dividend yields at the current prices. But you want to look for banks with a diversified customer base. So maybe think about geography. Also, you want big, diversification on both sides, right? Deposits and lending. One interesting thing about Silicon Valley is it didn't make a lot of loans. It had a lot of deposits, and then it put all those into treasuries and other things. It wasn't actually making loans to customers. Its customers were using it a lot for deposits. And the other thing is banks are basically a utility. They all provide basically the same service, right? Financial innovation has a pretty bad reputation, and for, I think, a pretty good reason. There haven't been a lot of actual innovations over the last several decades, right? Like securitization maybe is kind of an innovation. It's really just a way to do some things that people knew how to do before. Securitization is just a fancy word for it. And there's, some extra math that goes along there. Right? But as a utility-like institution, be sort of wary of rapid growth at banks, especially when compared to peers or the industry as a whole. So if you see a bank stock just take off, it's interesting and you may want to ride it for a while, but it gets kind of weird if all the bank stocks go up super high. All right, so last two slides about banks. This is Silicon Valley Bank in candlesticks versus the regional bank ETF, KRE, over the last 5 years. You can see Silicon Valley Bank just got real big, real fast, and then it came back to earth, right? I mean, it's a bank. That kind of thing just doesn't happen, right? So that's maybe kind of a warning sign. It should be, right, given all the things I just said about banks being a utility, et cetera. And then, All right, let's talk about the financial crisis and shareholders not getting wiped out. This is Citigroup over the last 20 years. It should not be hard to spot the financial crisis here. And yeah, right, like Citigroup shareholders are nowhere close to getting back to where they were before the financial crisis. So they didn't get zeroed, which I think, you can argue maybe some of those should. I think there's good reasons for not doing it at the time in any case. But yeah, they're still very underwater. So yeah, I mean, they got bailed out and the bank still exists. There's still some other stuff going on there. Executives maybe got paid more than they should have after having run a bank that, by all rights should have failed. But the shareholders have not recovered. All right, that is all I have to say about banks. I was a bank analyst and reporter from 2006 to 2009 or so. It was a very interesting time to study banks, and I'm still kind of interested in how the business works. All right, so the questions. Luca asked, he says, news comments, analysts, and fund managers in the media are giving bad signals and expectations to investors. Is it real, the risk that we're going to face worse times ahead and a crash in the stock market in the near future? And related to that, what is the best strategy for the long-term investor right now? What stocks are the best picks to avoid a bloodbath in case of a market crash? So this first two lines here is kind of my handy way to think about things that are on TV and how the news business works generally. So if you think about a spectrum from a plane that lands safely and on time, that's not news, right? That goes to, okay, sometimes a plane experiences extreme turbulence. You might see something about that in the news. Plane crashes, probably going to see it. Plane disappears from Earth and no one knows where it went. Huge news, they're going to talk about that one for weeks. So on that spectrum, if you think about that and apply it to financial media, you've never heard anyone say, stocks will probably return about 8% this year, maybe 9% with some volatility along the way. That's just describing the average year in the stock market, right? It's probably statistically likely to be the most correct position, but that is the financial, analysis version of plane land safely and on time. They're just not putting those guys on TV. Now, as for the second part of this question, this is where asset allocation and market discipline come into play. The way market works is there a discounting mechanism for information. If I knew the stock market was going to crash tomorrow, I would have sold all my stocks today. So would a lot of other people. Right, like essentially knowledge of a crash in the future creates a crash today. That's not how that works, right? If I had told you everything that was going to happen in 2020 at the end of 2019, you probably would not have positioned your portfolio for a massive rally, right? You just wouldn't. Nobody really saw that coming. So the way you handle that is don't put money you can't afford to lose in risky assets. Rebalance periodically, which typically means trimming your winners and adding to laggards. If we go back to the Silicon Valley chart here, if you have Silicon Valley because it's a bank and it pays a decent dividend, although it looks like it may not have paid a dividend here, but yeah, you have it because it's a bank and it's nice and steady, you probably are trimming this position all the way up. At least you should be, right? Because it's becoming a bigger and bigger piece of your portfolio, and you don't want to have this much of your portfolio in one relatively small regional bank. You just don't. So you do that periodically. And also remember that the riskiest stocks are often those that promise the highest returns, right? So your unprofitable tech companies, biotechs, things like that, those are places where if you're worried about the stock market crashing, you take some of that money off the table. Right? You're not you're not going to time the market to avoid the crashes and buy all the dips. That's not how this works. the way to invest for the long term is have some discipline, have some asset allocation that aligns with your goals, and then stick to it, right? It's pretty hard a lot of times to stare at a position that's gotten too big and be like, oh man, I just want to let this ride. It can be hard to sell that, right? That's basic human nature. It's how Las Vegas works, right? But taking some money off the table and then putting it somewhere safe is how you actually safely invest for the long term. All right, that's all the questions we got ahead of time. Let's see what we've got here. All right, Rob said, what is the outlook for oil prices having today dipped below the $70 support? Rob, I don't make a lot of predictions about oil prices because it's a very specialized sort of field. Typically what has happened is when oil prices start to slide, well, now I would think that the Biden administration is going to probably buy a little bit more oil to put back in the Strategic Petroleum Reserve. I also, kind of expect that some amount of drilling activity dries up as the price falls. That's kind of what happens. That's just kind of how the oil market works, right? It's a little bit, even if it's less so, it's a little bit of a boom and bust cycle. So you may see a little bit less there. It's starting to warm up a little bit, so some of the heating oil and some of that stuff, that demand goes away a little bit. But yeah, I don't really have a good long-term forecast for oil prices just because it's too volatile and there's too much stuff going on for me to really keep a good handle on it. I'm a little, well, yeah. I have some areas of expertise, but commodities isn't really one of them. I'm a little closer to a generalist in that regard. All right, some other people, it looks like, asked questions, but they left, and I'm not sure I know exactly what these questions mean. So yeah, if anybody else has any questions, I am here until 5. We are working hard on some updates to various parts of the service. We hope to add a few features in the next couple months, maybe improve some things. I don't have specifics or dates yet because I'm not in charge of allocating resources necessarily, and I don't necessarily know how long some of these things are going to take to build, but there's some pretty exciting stuff coming down the pipe, I hope, pretty soon. It's definitely coming down the pipe. I hope it's pretty soon, just to clarify that there. But yeah, it should be pretty fun. All right, so Peter says, is a replay available? Yes, it will be available probably tomorrow. We'll post it on the website and we'll send an email to everybody to let you know, that it's up there, but it'll be probably sometime tomorrow, midday or maybe early afternoon. All right, so another question says, how do bank stocks value react to rate changes? So higher rates are typically better for banks. Because because they make money by lending money. So if rates go up, every new loan they make has a higher interest rate attached, and also as I talked about a second ago, the rates on deposits went up, have almost not moved. They've gone up very, very slightly compared to interest rates on other things, which have gone up pretty significantly. So in a lot of cases, higher rates are better for bank stocks. Where it gets weird is when rates have gone up relatively quickly and banks have a lot of lower interest rate loans on their balance sheet. The value of those loans necessarily goes down. That can be an issue for banks. And generally, right, like having to pay some more in deposit on some of those things are probably likely to make them a little bit less profitable in the short term. But generally, higher rates are better for banks, and the banks have done relatively well this year until basically the last 4 or 5 trading days. So Louis says, why have banks not raised interest rates? Basically because they didn't have to. If you could borrow money at no interest and then lend it out at some interest, that's the best case scenario, right? So like I said, I would expect to see, you might see a few more banks raising interest rates now to try to keep some of those deposits in-house. But, you know, if I'm running a restaurant, I don't, I don't force money on the meat guy. I just, pay him whatever he charges. And so if people are willing to make bank deposits and put money there at 0 interest, the banks aren't going to raise them. They just don't have to. And so, yeah, that's basically why. All right, so would you buy bank stocks given recent events, even though the stock prices are depressed, maybe unnecessarily? So yeah, I mean, I think if you think bank prices are depressed, perhaps unnecessarily, it's maybe an attractive time. Like I said, I think there are some questions about profitability going forward. I don't necessarily think they're going to drop, right? I don't think bank profits are necessarily going to drop to 0. Some of the banks, if you look around, are paying a pretty solid dividend. If you think it's a steady sort of thing, a relatively solid bank, and it pays a decent dividend, it may not be a bad time, right? Like certainly this might be buying a dip. I'm interested to see how some of these other things shake out. I think trading yesterday and today was relatively positive in terms of, we're not seeing more bank runs or a lot of capital flight out of the sort of banking sector generally. That's, I think, the piece that's harder to predict is, it turns out they can be the best bank in the world, but if everybody takes their deposits out, well, now it's the worst bank in the world. And whether they took them out because the bank was bad or the bank went bad because people took all their deposits out, at a certain point, it stops mattering, right? So if people will stop panicking about the safety of banks, then banks will be fine. And it's, maybe a pretty solid time to buy bank stocks. It kind of sort of looks like the panic has started to subside. But yeah, I get worried trying to predict the psychology of crowds because lots of things happen that I wouldn't have necessarily predicted. I mean, the whole GameStop thing is sort of the other direction, right? I thought it was too high, and then it just kept going up and kept going up and kept going up. And I still think I was right, but yeah, I don't get points for accurately valuing a company when the price keeps going up, and I don't get points for being correct about a bank being healthy, and then everybody wants to sell it, right? If the price goes down, the price goes down. What happened to GitLab to cause it to decline so rapidly? I think it was just earnings, or maybe something about guidance. Oh, that's not the right ticker, GTLB. I think we mentioned it in here. Nope. All right. Yeah, I'm pretty sure it was earnings. Something in their earnings report. In any case, I didn't study it super closely, but yeah, they announced some layoffs and some other stuff. Generally, the sort of growth in the tech space has sort of slowed down. So David says, do you see any inverted yield curve for an extended period of time? It's tightened up a lot. I don't necessarily, well, one, I don't really know what you mean by extended. And two, I don't really know exactly when I would expect it to uninvert. Essentially, what's happening is the longer dated bonds, right? So your sevens and your tens are right, sort of betting on that the Fed will stop raising rates and start cutting sooner rather than later. So one way to think about bond yields is what do you expect the average Fed interest rate to be over that period, right? So people are saying, well, rates are pretty high now, but the average over the next 10 years is probably lower than the average over the next 2 years. That's essentially why that yield curve is inverted like that. And I don't know exactly how high rates will go. They're right now not that much higher than they were for a lot of the past the Volcker stamping out inflation period. A lot of the sort of late 80s and 90s. Interest rates have been very, very low since uh, the Great Recession and financial crisis. I think it's going to be hard for people to maybe get used to the idea that interest rates might be 4 or 5% just as a matter of course, as opposed to 1 or 2 or 3%. So yeah, it'll be interesting to see if something happens that causes the Fed to cut rates, or people slowly start to raise their rate expectations as that goes. One of those would cause the curve to uninvert, but I'm not really sure which one it's going to be. So if SVB depositors were being paid next to nothing for keeping their hundreds of millions there, then why did they? That's a good question. Some of it is because SVB did make a few loans, and sometimes those loans had covenants that said you have to keep your deposits here. In some cases, venture capital funding was dependent on keeping your deposits at SVB. And generally, right, like bank deposits just aren't paying a lot of money right now. And so I think people were, I mean, the entire episode really is a sort of a lesson of people being used to a zero interest rate environment, and interest rates aren't zero anymore, I think. Is generally what I think this is a lesson in. So yeah, I can't speak to the motivations of any individual company. It certainly seems weird to me that you wouldn't go try to get some yield on some of that if you didn't need it for short-term working capital. But yeah, I'm also not the CFO of a company that has hundreds of millions of dollars, so there may be some other reasons that I'm missing there. Yeah, Robert, I think there was a lot of panic earlier this week. I think if there aren't more shoes that drop relatively quickly, we'll probably see some rally in the short term. 3 weeks ago, I was saying that I feel like tech stocks have gone up too much so far this year. And then the bank stuff sort of blew all that out of the water. So, there's always possibly some surprise waiting to happen that I can't tell you about. But I think if we get some return to calm and normal in the markets, we don't have another bank blow up or anything like that. I think in the short term, especially some of the bank stocks and other financials that have been beaten up this week pretty badly, I would expect some rally there, which probably likely to carry over somewhat to the major indices. But it's kind of hard to say. Yeah, so yes, expiration, options expiration, there's probably a lot of things that are, right, that monthly and quarterly expiration. That's another interesting dynamic later this week with that quadruple witching. We may get a rally based on that. That wouldn't be super surprising. You tend to have things come back to where most of the options are, and I feel like we're probably a little bit below that level at this point. I haven't actually looked at it super closely, but my guess is the big drops the last few days have probably pushed a few more options out of the money than people may be comfortable with. So you may see some pinning and things come back up through the end of the week like that. All right, this is this is the end. Thank you all for coming. Like I said, this was recorded, and we'll make that recording available tomorrow. Thank you for coming. Thank you for subscribing to Investors Observer. Our next workshop will be in 3 weeks, which is I think like April the 5th, maybe. Yes, April the 5th. So I will talk to you again then. In the meantime, you can hit this help button here and send us an email. We get back to most of those the same day. If you have any questions between now and then. But yeah, thank you for coming. Thank you for subscribing to Investors Observer, and I will talk to you again soon.